if you're a salaried individual in India with straightforward income sources. ITR-1 is likely the tax form you'll be using. Understanding whether you qualify for this simplified form and how to file it correctly can save you time, money, and potential headaches with the tax department. This guide covers everything you need to know about ITR-1 for financial year 2025 to 2026, which corresponds to assessment year 2026 to 2027. ITR-1, often called the Sahaj form, is specifically designed for resident individuals with simple income structures. The key word here is simple. Not everyone can use this form, even if they think their finances are straightforward. The Income Tax Department has clear criteria that determine eligibility. You can file ITR-1 if you meet all of these conditions. First, you must be a resident individual. Non-residents and residents, but not ordinarily residents, cannot use this form. Second, your total income for the financial year must not exceed 50 lakh rupees. This is a hard cap. Your income sources must fall within specific categories. You can have income from salary or pension. You can own one house property, but only if you're not carrying forward any losses from previous years. Income from other sources is allowed, which includes interest from bank accounts, family pension, and dividends. Agricultural income is permitted, but only up to 5,000 rupees. For assessment, year 2026 to 2027, there's a specific provision for long-term capital gains under Section 112A, but only up to 1,25,000 rupees. Now let's look at who cannot file ITR-1. If you are a director in any company or hold unlisted equity shares, this form is not for you. Anyone with income from business or profession must use a different ITR form. If you own more than one house property, you're automatically disqualified from using ITR-1. Capital gains beyond the specified limit make you ineligible. This includes both short-term and long-term capital gains exceeding the threshold mentioned earlier. If you have any foreign assets or earn income from sources outside India, you cannot use this simplified form. Anyone whose total income exceeds 50 lakh rupees must file a different return. Finally, if you have brought forward losses from previous years or losses to be carried forward to future years, ITR-1 is not applicable. Before you begin the filing process, gathering the right documents is crucial. These documents help you verify the pre-filled information that appears on the e-filing portal. Form 16 is your primary document issued by your employer. It details your total salary and the tax deducted at source throughout the year. Form 26AS, along with the annual information statement and tax information statement, are available on the e-filing portal. These consolidated tax statements are essential for verifying that all tax deducted from your salary and interest income matches government records. Keep your bank statements or passbooks ready to calculate the exact interest earned on savings accounts and fixed deposits. If you're filing under the old tax regime, you'll need investment proofs. This includes receipts for deductions under Section 80C, such as Public Provident Fund contributions, life insurance corporation premiums, and equity-linked savings scheme investments. Health insurance premiums under Section 80D and home loan interest certificates are also important. Make absolutely certain your Aadhaar and PAN are linked. Unlinked documents can lead to rejection of your return. Timing is critical when it comes to filing your income tax return. The due date for filing ITR-1 is July 31st, 2026, unless the Central Board of Direct Taxes announces an extension. Missing this deadline triggers penalties under Section 234F. If you do miss the July deadline, you can still file a belated return until December 31st, 2026. However, this comes with a penalty of up to 5,000 rupees. If your total income is below 5 lakh rupees, the penalty is reduced to 1,000 rupees. It's always better to file on time and avoid these additional costs. The Income Tax Department has streamlined the online filing process with automation and pre-filled forms. Start by visiting the Income Tax e-filing portal and logging in using your PAN. Once logged in, select Assessment, year 2026 to 2027, and choose Online as your filing mode. One of the first decisions you'll make is choosing between the new tax regime and the old tax regime. The new regime is set as the default option. It offers lower tax rates but provides fewer deductions. The old regime allows more deductions but has higher tax slabs. Consider your specific financial situation before making this choice. After selecting your regime, carefully verify all pre-filled data. Check your personal information, gross total income, and taxes paid sections. Cross-verify every detail with your Form 16 and annual information statement. Even small discrepancies can cause processing delays or trigger notices. If you're filing under the old tax regime, ensure all eligible deductions are properly reflected. Common deductions include Section 80C for investments, Section 80 TTA for savings account interest, and Section 80D for health insurance premiums. Double-check that these amounts match your actual investments and payments. The final and often overlooked step is e-verification. Your return is not considered complete until you verify it. The simplest method is using Aadhaar OTP, which provides instant verification. You must complete this verification within 30 days of filing. Unverified returns will not be processed, rendering your entire effort meaningless. Here's something many taxpayers don't realize. The tax department already knows about most of your income sources. Before you start filling out your return, download your annual information statement. This document shows all the information the tax department has received about your income, including that fixed deposit interest you might have forgotten about or dividend income from shares. The department receives this information directly from banks, employers, and other financial institutions. If there's a mismatch between what you declare and what appears in the annual information statement, you're likely to receive a notice. It's always better to declare everything up front, even if it means paying a little more tax, than to deal with notices and potential penalties later. Filing ITR-1 doesn't have to be complicated if you meet the eligibility criteria and have your documents organized. Take the time to understand whether you qualify, gather all necessary paperwork, verify pre-filled information carefully, and complete the e-verification process. By following these steps and being thorough with your annual information statement review, you can file your return confidently and avoid unnecessary complications with the tax department.